Okay, we are going to continue with our lesson. I was talking about internal source. Something happened to the video. The internal memory was full, so we have to switch it to the external memory. But because I had done much, I wouldn't restart. So that is why I'm continuing at this point. Now, I was talking about depreciation, and I said when you buy an asset, the value falls. And I was telling you how it happens. So I said you bought an asset 50,000 Ghana cedis, and then you were going to use it for 5 years. If that is the case, then it means that the asset will be spread over the period of 5 years. So it means every year the value of the asset will fall by 10,000 Ghana cedis. Because if it is 5 years, it means 5 times 10 is 50. So every year the value of the asset will fall by 10,000 Ghana cedis. So this year you bought it. In your books of accounting, it was 15,000. Next year, it will fall by 10,000. So now, the value of the asset will now be 40,000. Then, next year or the following year, it will fall by the same 10,000. So now the value will be 30,000. 10,000 another year, the value will be 20,000. 10,000 another year, the value now will be 10,000. Then the last year, the 5th year, it will be 0. So what does that mean? What it means is that if you something that you bought at, let's say 50,000, after 2 years, it will be 30,000. Now, what is the essence of this provision? So in accounting, they provide for depreciation. What is the essence? When they provide for depreciation, if you start doing trading profit and loss account, you prepare your trading account to get your gross profit. You prepare profit and loss account where you some expenses will now be deducted from your gross profit, and you get your true profit, which you call in accounting net profit. Now, because provision for depreciation is an expense, it will reduce your profit. When profit is reduced, it means you will pay less tax. You get it? When the profit is reduced, you will pay less tax. So if you are paying less tax, I think you are supposed to pay without the provision for depreciation, you are paid just a tax of 1,000 Ghana. But because you are provided for depreciation, you are going to pay, let's say, 700 Ghana cedis or whatever lower than this one. So 300 Ghana cedis. This 300 Ghana cedis can be accumulated for a very long period of time or a period of time for business operations. So that is how provision for depreciation becomes a source of financing your business. Apart from even that one, the money that you also accumulated by providing for depreciation, you can accumulate it and then channel it towards business operation. So that is for provision for depreciation. In summary, provision for depreciation will reduce your profit. When profit is reduced, your tax will also reduce. The money that you could have paid as tax can be accumulated for business operation. Now, so that is what these are the internal sources. Now, the external sources, we have almost done all of them. We have talked about bank overdraft, we have talked about bank loan, we have talked about mortgage, we have talked about high interest, we have talked about leasing, we have talked about sales and leaseback, we have talked about sales of shares, which is for companies, we have talked about debentures. The one that probably we have not talked about is factoring. Factoring. What is factoring as a source of financing your business? Factoring. Now, in accounting, when you start preparing profit and loss account or account for the sole proprietor, you also prepare the balance sheet. When you go to your balance sheet, it is divided into portions. A portion of the balance sheet, they call it current asset. Another current asset, you know, you sell goods to some of your customers on credit. So they become your debtors. So you may have somebody called Mr. A, another person called Mr. B, another person called Mr. C, Mr. D. You must have sold good to Mr. A on credit. And Mr. A is supposed to pay you 20,000 Ghana cedis. Mr. B do the same thing, he's supposed to pay you, let's say, 10,000 Ghana cedis. Mr. C is supposed to pay you 30,000 Ghana cedis. Then Mr. D is supposed to pay you, let's say, 5,000 Ghana cedis. Now, if you add all these things together, 20,000 plus 10,000 plus 30,000 will be 60,000 plus 5,000 will be 65,000 Ghana cedis. This 65,000 Ghana cedis, these are your debtors. So that is debtors. To the total debtors, the sundry, they say the sundry debtors, the total is 65,000. When you go to your balance sheet, you see that this one is what will be there. It is an asset because you can turn this into cash. When they come to pay, you can get cash. So that is why it is an asset. Your debtors are your asset. And you cannot go to the balance sheet and then you write this person's name, you write this one, no. They will bring everything together, then you write debtors. Now, the debt can go bad. In other words, Mr. A can decide not to pay, B can decide not to pay, C can decide not to pay, this one can decide not to pay. Or they may pay part. Let's assume they don't pay anything. That means you are going to lose 65,000 Ghana cedis. But fortunately, some companies have been established, and the main reason they were established is to buy debt. So they buy debt. We call them factors. Companies that are established and then their objective for establishing the company is to buy debt are called factors. So factors are companies that buy debt. It may surprise you that why should somebody establish a company and then what the reason for the establishment of the company is to buy debt. That is what they do. They say then how would they make profit? Very simple. This is the 5,000 here. That is standing in your book. I'm using an accounting term. They will say it is standing in the books of account. So this is the 5,000. The company, the factor, the company that buys debt can come to you and say, we want to buy your debt. But they will not buy it at 65,000. Through negotiation, they may buy this debt at, let's say, I'm just assuming, they will buy it at, let's say, 40,000 Ghana cedis. If they are able to go out to Mr. A, B, C and take all the money, then it means that they are going to make profit of 25,000 cedis. We are assuming no other expenses will be made. So they will make profit of 25,000 cedis. Now this 40,000 they gave you becomes a source of financing your business. Remember, there is what you call bad debt. What is bad debt? Your accounting teacher will teach you. But it's very simple. Bad debt means that debt that you're supposed to be paying, if they refuse to pay, it has become bad. And in accounting, you say you write it off. You write it off. At a certain time, you write your debt off. Because if it has stood in the book for a long period, then you may have to write it off. But you may have a company that will come and buy your debt and then give you money. Then when they give you money, then you can now use the money, 40,000 for business operation. So in what is, you see, I've explained to you. So what is factoring? Factoring is the process of buying or selling account receivable. It is the process of selling. The company sells account receivable. You say, what is account receivable? I have told you every subject has its own language. So in accounting, when they say account receivable, it's the same as saying debt. So in other words, it's the process of selling your debt to a factor. Once the factor buys you can use the money for your business operations. Then the onus will be on the factor to go around. Now you have assigned responsibility of collecting the money from your debtors to the factor. So the factor can come to Mr. A and take the money, to B and take the money, to C and take the money. If they don't pay, the legal action can be taken against them. Now, you say, why was it that the company was not able to take it? These are the factor, that is their special area. They have specialized in collecting debt, and they'll be able to collect it better than you can do, because that is their work. That is their work. So that is what we call factoring. Take note of that. That is what we call factoring. So when we talk, so we are through with internal and then external sources of finance. That means that brings us to the end of our topic, sources of business finance. And as I indicated earlier, that also brings us to the end of our vacation learning. When we meet in school, we will continue with that. But let me acknowledge some people who help us to make the video. We have done 4 topics throughout. Most of the videos, it was Richard Medi, Form 3 Business, that helped me, and that he was the one who did the video. So I would say he was the camera man. And some other visual art students, if he was not around, I contacted them to do that. This last video you are watching, you know, the previous one, that was done on a Saturday, and Agbesi of Form 3 Business B also helped in that regard. And the last video that you are watching now, it was also Godfrey from 3 Business B that also did that one. Now remember, you are supposed to take your time. You see, I took my time to do this one because you know sources of finance is in your book 3, and you don't have the book 3. It's Form 3 topics, and I've given the reason why we are treating it now. So take your time, make notes. I'll give you questions on your WhatsApp platform to answer. So as you are watching, be attentive, make notes, so that when I ask you those questions, you don't even have to come back to the WhatsApp, because you have already made notes, and you can make reference to your notes to answer those questions. Don't forget, you already have vacation assignments. I also gave you an assignment on stock exchange, and you certainly have assignment here. See to it that you do your assignment and submit the assignment on time. I told you, the day school reopens, that is the day you submit the assignment. Don't forget to make comments. That is the only way I will know you came to watch the video. So you have to make comments. If you want to ask any question, ask the question, and the question will be answered. If you have not subscribed, better do that too. So we meet again another time, whether in school or for one reason or the other. If you come here, if I get time, I always tell you, if I get time, we are going to also, I'll come out and then give you some questions. We can make a video, and then that will be only question, like I did the other one, objective. But if time doesn't permit, then when we meet in school, then we shall continue. So we meet again at another time.